Hello and welcome to Thank God It's Friday. The benchmark indices are near lifetime highs, but the question is, what is the road ahead? What are the challenges and potential opportunities? And for that, we are in conversation with Prabhat Awasthi. He is the Managing Director and Head of Equities at Nomura India. Prabhat, thank you for joining us.
Thank you very much for having me.
Well, so I'm going to start off with the usual question. Now, benchmarks are where they are, but any fresh triggers that you can think of that could lead these indices higher, and are there any potential problems in the horizon that could actually lead to a correction from here on?
So I think just in terms of what drives the markets, actually, end of the day, markets are driven either by earnings or multiple expansion. Only do these two things. And the concern essentially has been that there has been a re-rating of the market because when markets rise very quickly, obviously earnings don't change that quickly. So ultimately earnings have to show up. Our view is that we are in that stage of sort of pickup in earnings on a structural basis. Obviously we had a quarter which was comparatively marred by the fact that you had 2 months of demonetization, and maybe this quarter also you'll have maybe a month or so of slow growth. But structurally there doesn't seem to be damage. So the growth trajectory that was sort of quite visible before demonetization happened, if you looked at aggregates among sectors, there was clearly a sort of pickup that was going through. We think that economy will come back to sort of growth path, and you'll start delivering some amount of or accelerating earnings growth going forward.
Right.
And that's what will drive it. The other thing is that our earnings is market at risk from a correction in multiples, and multiples are a tad expensive compared to history, but not like not very expensive sort of zone. Market is close to 17.1, 17.2 times. Historical average about 16.5 to 16.8, so maybe 3-4% more expensive. But also remember that we have had a big correction in interest rates in India compared to global rates, and that also means that there will be some uptick to multiples because of the fact that your cost of risk-free has gone down.
Right.
So I think markets are fine. They will might look expensive because they've rallied very quickly, but sure, I'm not that worried at this point in time.
Okay.
Right. Prabhat, FIs have been net buyers of Indian equities on every single day in March. Do you think this trend is here to stay, or do you think there are some global risks that the Indian markets are not really pricing in, which could sort of lead to these foreign funds pulling out for in the rest of the year?
Very tough question to answer, because usually to forecast funds has always been tough. For example, if you're sitting in last quarter last year, there was a fair amount of selling, but the markets though refused to fall. And I think obviously the risks from global funds perspective will always be, the risk will be largely global, not that much local. I don't think when we talk to foreign investors, they're very comfortable with the India story per se. So if you're going to see outflows, it will be largely because of global events. It could be that, for example, you have a correction in US markets, for example, because of what's going on the policy side. If people start getting concerned that the Trump agenda is not moving forward, if you don't get healthcare through, for example. I mean, it could be a variety of things. That could cause a short-term reaction as far as market is concerned. But I would still say that if you look at a 5-month picture, foreigners have not really been net buyers. It's only this month that you're talking about, and they have not been the main drivers of the market this year or last 6 months. This is first, and to me, it could very well remain to be the case, even going forward, because I think there is definitely a structural upturn in amount of money that is coming through into Indian equity markets.
Right.
Yes. All right. So Q3 didn't turn out to be as bad as expected, the December ended quarter. But of course, Q4 would obviously going to be a better gauge of that return to normalization after the currency ban. And like you said, that Q4 seems to be more like slow growth. That should probably come in. That's what you just said in your opening lines.
Well, I won't say that. What I said was there will be another month or so of demonetization impact. Okay. Not really say that there is a huge impact of. So if we talk to companies, for example, across sectors, the by and large, no company is saying that we are worse off than last 3 months. So in general, people are saying that there has been a recovery over what we saw in the first 2 months of demonetization. So things have normalized more or less. So I don't think there is a huge sort of. I don't think things have decelerated from last quarter, but I think they're going to be relatively slower compared to what they would have been had demonetization not happened.
Right.
But I don't think there has been any companies telling us, for example, that they're worse off than we were in third quarter.
Right.
So fourth quarter is not worse off for sure, but it's just that you were on a trajectory, you got bumped down a bit, and you're probably sort of in the recovery phase. So you might have one more month of some lingering impact of demonetization.
Right.
That's it.
So I'm sure earnings with respect to FY18, a lot of that's going to depend on the monsoons. But there is also the teething problems with respect to the goods and services taxes. Now there's a feeling on ground that it may take longer than just a couple of quarters for industries to adapt to goods and services taxes. Based on that, when can we really see robust growth come back in the Indian equities?
You're talking about earnings, right?
Yes,
so,
earnings,
yeah,
yes.
Yeah. So as far as GST is concerned, GST is a change of tax regime essentially. The fundamental underlying growth in earnings is usually not going to be affected by a taxation change unless that taxation is causing large scale changes to amount of tax collected by the government.
Right.
So for example, if government is talking about a neutral tax change, for example, they're saying that we're going to charge less, manufacturing less and services more, but on net basis, the overall that we charge in terms of taxation is same, which is what it's supposed to do. The GST is supposed to tax neutral rate. Then from consumer's perspective, you are not hitting his pockets. You're taking in one bucket and probably giving back in one bucket. Will the consumer stop buying a car or stop buying a soap just because you're putting in GST? I frankly am very skeptical about that notion. I think there might be some short-term changes in terms of how inventories are kept by retailers. So it will be a very short-term disruption. Long-term disruptions, why were we more scared about demonetization? Because people thought that this will derail the economy in the sense that people will lose their jobs and demand will fall off for a very long period of time. GST does nothing of that sort.
Right.
All it does is it changes the tax regime. So I personally think that GST will be, from market's perspective, it might be very short-lived sort of impact, if any, simply because it doesn't do, it doesn't change the fundamental construct of the growth in GDP or in demand. Now, from earnings perspective, I think what we are seeing essentially is, a sort of a very slow recovery, gradual, and I think that is a path we will be at. So, I don't know what you mean by robust, but I think in about a couple of quarters, maybe 3 quarters, we will be sort of starting to average about 15-16% sort of earnings growth, which is, I don't think in current global context also is a bad number.
Yes. Okay. So that brings me to the consumption sector, and in this case specifically FMCG companies. And there are a lot of these FMCG companies who always traded at substantially higher valuations, not only to the market, but guys like HUL, ITC. ITC, of course, it's a recent phenomenon, but HUL, Marico, Dabur, they've also been trading at valuations higher than their historical averages. So if you take a previous 10-year price to earnings average. My question is, what do you do with these stocks? If they are always going to remain expensive, do they become a part of your portfolio which is more focused towards your capital conservation as compared to appreciation?
Again, I sort of disagree with that. If it was capital conservation, then they wouldn't have returned you the returns they have returned. So they've returned pretty decent returns.
Okay.
So I don't think it's been capital conservation.
Right.
You're right that the multiples in this sector expanded quite a bit, and there's a good reason for it. The reason essentially is that in protected earnings environment, or for a set of stocks where the earnings are far more protected,
right,
and the fact is growth elsewhere is falling off, which is making overall cost of capital much lower, because essentially when growth rises, the capital consumption rises, and when the growth falls, you're consuming less capital becomes cheaper.
Right.
And in that environment, if your growth is same, then you get priced up because your cost of capital has fallen with respect to your growth.
Right.
So essentially, it is not that the stocks are defensive. The stocks are defensive with respect to the cost of capital. The point I'm trying to make is that obviously now we are in an environment where, especially in India, where growth is starting to pick up.
Right.
So you could make a long-term case that there is some risk to the multiples if global growth, for example, continues to pick up. But it's going to be very patchy sort of recovery globally. So if you look at globally, for example, consumer stocks multiples have gone up everywhere. It's not only India. So I would say that, with respect to the cyclical sector, there's a good likelihood over the next 3, 4, 5 years, these stocks will perform. However, with respect to the question is that you look at when you build a portfolio and you're long only investor and looking at 3 sectors, let's say you've got technology, you've got pharmaceuticals, and you've got consumer.
Right, yes.
Which one do you pick? And our pick this year has been, so we've been underweight consumer for a while because of this whole issue, but this year our view is that the challenges in other sectors are larger, so we have become overweight simply in that defensive space.
Right.
Because you have protection of earnings. We think that the multiples are in no imminent danger of collapse.
Right.
So you'll get your, earnings are still coming through to some extent. So should be okay overall in a portfolio sort of construct.
All right.
I want to bring in the banking system. Just yesterday at an event, the finance minister was talking about bringing in some proposals to address the NPA issue. Previous measures like your SDR, S4A, 5x25 refinancing don't seem to have helped much. So, and of course, at the same time, credit growth continues to be at multi-year lows. So, what is the road ahead for PSU banks, and is consolidation really a solution for growth for PSU banks specifically?
Okay, so 2 questions I think there. One is about the growth itself, and the second question is what we do in NPAs. So I think part of the reason why NPAs have not really, most of the solutions have sort of not worked is, I think from what we understand, obviously there have been continuing challenges, first of all, because, for the last 2 years, for example, metals slid into sort of difficulties 2 years ago only, when the whole global metal cycle went down. It's recovered somewhat now. Many projects which are getting built are now sort of coming into production stage and not able to repay their debt. So all that has been a sort of, there was such a big capex cycle that the impact of that in terms of how NPS come through has been also faced.
Right.
I think we're done with that sort of fresh NPA creation. The problem is what do we do with what we have? And there the challenges I think, and I think it might be more true of PSU banks, because their ability to take haircuts in Indian context and Indian legal context, given the vigilance issues, etc., around them, has probably been limited, and therefore consensus around resolving some of these thorny issues as to how much haircut is to be taken, etc., have been tougher. And if the government can come in between and either resolve that or take it off their books at a fair price, that'll be, so I mean the solutions that have been talked about are obviously making committee or getting a bad bank in place or whatever. But end of the day, the problem has been essentially in terms of decision making in the context of Indian, well, not legal I would say, but the supervisory system of banks,
right.
CBC and CBI, etc., being a problem. So if the government with a fresh mandate from UP is in a position to do something bold, that will be very, very helpful. Now the question of growth and credit. I personally think credit growth is going to be a bit more independent. Obviously, if the banks are lending, with more abundance, some credit growth will pick up. But end of the day, there's a cycle which depends on the external environment. If people are going to put more projects, then credit growth will take off. My own view is that credit growth will take a longer time, because if you look at the last 5 years, so many assets have been put up in telecom, in power and steel, and these sectors are going to be in repayment mode for a very long time.
Right.
So basically a very large part of credit cycle which is related to steel sector or metal sector or power sector is not necessarily going to be in a mode to build fresh capacities. They'll be in a mode to repay. And the new sectors which are coming up, not large enough to sort of offset that repayment mode, I think you are going to, even if the growth picks up, the credit growth will lag it. And that's always the case in this kind of cycle which we saw, we call a huge capex cycle, and we saw huge meltdown. In that kind of scenario, credit growth will always lag. So I think our view essentially is that the consumer side of credit, which will probably be healthier compared to the which frankly you don't need geniuses to sort of think through that, but our view is that credit growth will be much more lagged and therefore slower, and it might not, looking at credit growth might not always tell you what's happening in the economy.
Right. Okay, so I'm actually tracking a lot of the other brokerages who have turned slightly positive towards the information technology sector, and I'm talking about largely the large players. Um, is information technology a compelling buy right now? If it isn't, what are the factors that you'd like to see change before it becomes one?
So I think our concerns are more fundamental. One is that we think that there obviously we think there are two things which have happened fundamentally. One is that they have started to face the traditional business model not working as well as it used to be. There's automation, there's migration to cloud, etc., etc.
Yes, yeah.
And I don't think anybody sort of has figured out whether this trend, because if you look at global growth has picked up, but their sales, their volume growth has essentially been sliding down.
Right.
And that might continue, and we just don't see any signs of that changing at this point in time.
Right.
No commentary is changing. Even global players are still telling you that things are still quite weak. So the link between growth globally versus the growth of IT majors seems to have been broken. So that's the first point. Second point is that we think that multinationals are able to have copied the model of Indian IT pretty well. So there is a loss of market share which is going on compared to Indian IT companies. Third, which is not fundamental, related to their own fundamentals, is the fact that rupee is turning out to be a bigger headwind than people thought, because rupee has, if you look at between, for example, 2007 to 2014, rupee appreciated by about 50%.
Right. Yes.
What did we get in terms of earnings impact on tech companies? Did earnings rise in conjunction? No. So now we are in a situation rupee is actually not providing any help. So we are sort of, stocks, if they are not dirt cheap, will turn only when the fundamentals turn.
Right.
Even a little bit. We
Yes.
just don't see a sign of that at this point in time.
Right. Okay.
All right. Your thoughts on retail companies, because some of these stocks have really run up significantly in the backdrop of T-Mart IPO, of course. You said that in terms of your pecking order, you wouldn't rank consumer companies very high. Is it the same with retail stocks?
We don't cover retail stocks. Very sorry about that.
So no thoughts on retail at all?
No thoughts. I mean, no. We really we will cover some stocks mattering of that, but not as a sector. I think if you really, you ask me from a very macro perspective, having looked at retail companies, I think it's the model which succeeds rather than, it's the company which succeeds rather than the sector itself. It's very clear that companies which have been in the sector for such a long time have just not succeeded as the company you mentioned just now. It's, I think, more down to the execution of one particular player rather than the sector itself. There obviously has been a lot of promise, but the delivery essentially has happened from a player which was relatively new to the market, right? So that's my only comment. I just don't know whether, as I said, we don't cover the sector, can't really offer you more.
Fair enough.
Sure. Okay, so we are addressing a relatively younger crowd right now. And we often get this question about how do you know what stocks to avoid. So what are the top 3 or 4 flags, red flags that would make you decide that this is an absolute avoid and you will not touch this stock?
Okay. I think the first principle of investing is that you don't invest in companies which destroy value. How do you see companies destroy value? If their return on equity is lower than the asking rate of a return, right?
Yes.
So if you're buying a company which is earning a 12% ROE, then if you, whatever book value, which is the equity shareholders value, it'll trade at discount. So, but the only thing that sort of one must remember is that they're cyclical companies which go through a boom bust cycle, like steel sector, for example, where the return in the lower end of the cycle will always be much lower than but it averages out, right? So those cyclical companies can be bought at lower points in cycle, but that takes a lot of discipline investing and a lot of heart, that you buy a company which is down in the dumps where sector is looking terrible, and then you have the heart to buy it because you have those guts too. But from a long-term perspective, for investors who are just investing, and don't have the ability to track day to day, I think the first, as I said, principle is that companies don't destroy value. The other way to look at it, companies will generate free cash flow.
Right.
But again, the flag is that company is growing too fast, it will not generate. So I think between the ROE and the growth, you sort of can make out whether the company's business model will work in the long time. The company generating low ROE and growing fast, it's a recipe for disaster.
Sure.
company generating high cash flow, high growth, but has cash flow requirement from outside,
Right.
that is fine to invest, as long as you think that the ROE profile is not deteriorating.
Right.
So end of the day, it always boils down to whether the company is generating returns on its business. The environment, ability of the company to grow in a particular environment is either dependent on the environment itself, or as you said in retail, for example, the ability of the company to figure out a business model which is
Right.
superior and take market share gains. So if you, for example, in banking sector bought banks which are generating superior ROE, over the cycle you would have made tons of money, and they'll
Right.
probably still make tons of money because there's a large opportunity out there. If you had bought consumer stocks over a long period of time because they're generating high ROEs and growing at 15%, you always made money.
Right.
You could be in a situation buy it 30 times and you sit on your stocks for 4 years, 5 years. It's possible in today's environment. So the third thing actually is therefore valuations. So if you can get in these kind of markets, it's tougher to find those stocks,
Right.
and therefore, I think that's one of the reasons why mid caps are doing so well, because if the economy picks up, the ability of these companies to grow much faster is longer, for a longer period higher, because its size is smaller.
Right.
For a much larger company to grow on a large basis, but again, that's not an easy sort of one to do. It again requires a lot of business analysis. So I think valuations, the return profile, and growth. Between these three things, if you got, and you need to do a lot of work to figure that out, frankly.
Of course, yes.
Any minimum criteria for ROE that you generally look at?
There's no minimum criteria.
No,
I mean, the
yes.
point is that if your cost of equity is 13 and you generate 13, you'll trade at one time
Right.
price to book.
Right.
If you're generating 18, then you might start trading at 3 times price to book on a sustainable basis, 18%. You're generating 30 and you're growing at 15%. So I think growth is also equally important. So multiple that is derived essentially is not only the ROE premium that you generate over cost of equity. How much can you deploy? How fast? If a company has got a 30% ROE but not able to grow, it'll trade 8 times.
Right.
And as it sort of rises, if it goes to 15%, it'll start trading at 30 multiple.
Right.
So
Right.
the question is essentially that mismatch we can figure out.
Absolutely. Thank you so much for your time,
pleasure, mine.
Prabhat, and thank you for your perspective. As for you guys, we'll see you on yet another session of Thank God It's Friday. Thank you for watching.